This is an article from November 11th, 2009, by Jamie Fried. AMP AXA Big Four's fifth pillar fright. There has been plenty of speculation in the market that AMP's joint bid for AXA Asia-Pacific could prove a catalyst for one of the big four banks to launch a takeover bid for AMP to prevent the deal from happening. The thinking is that the combined local operations of AMP/AXA Asia-Pacific will form a fifth pillar too big for the banks to buy due to competition concerns. However, Goldman Sachs JBWere thinks there is unlikely to be an immediate bid for AMP by any of the big four. It points out that the banks would almost certainly dilute their earnings per share and return on equity by a few percent by purchasing AMP, and they would need to be willing to take on the regulatory risk AMP is facing in the near term. But the most interesting point is that the window for the banks to act may not be as small as it looks, because the complex scheme of arrangement proposed by AMP and AXA SA to acquire AXA Asia-Pacific could take 6 months to implement, even if it is approved by the board of AXA's local arm. Goldman Sachs JBWere thinks the banks would prefer to have the luxury of seeing how the regulatory review plays out and the ability to keep their powder dry in case AMP's bid for AXA Asia-Pacific fell over, which would leave it more exposed than ever. Finally, the broker noted the talk of a takeover bid for AMP by one of the big four is perversely increasing the value of its scrip bid for AXA Asia-Pacific, making it more likely that deal could proceed. Another possible outcome could be a big four bank bidding for AXA Asia-Pacific's Australasian arm in concert with AXA SA. The exclusivity agreement between AMP and AXA SA released to the market yesterday showed AXA SA could give 1 month's notice before February 6th to end the partnership if it received an unsolicited approach from a third party with a better offer for a joint bid.